Workday is exactly the kind of company that was supposed to look safe in a shaky software market. It sits in HR and finance. It serves big enterprises. It has deep workflows, high switching costs, and a platform that touches things companies do not casually rip out, like payroll, planning, and core people systems. So when a company like that gets hit hard, it matters. Not because Workday is broken in some cartoonish sense, but because even a premium name like Workday can lose the market's confidence, then the rules for software investing are changing faster than a lot of people want to admit. And that's the real story here. The stock did not collapse because Workday suddenly stopped being relevant. It fell because the market stopped treating it like a premium, low drama compounder and started treating it like a company caught in a strategic transition it has not fully explained yet. Reuters reported the shares fell 8.3% after weak fiscal year 27 subscription guidance hit a more than 5-year low, and we're down about 40% year to date at that point. Reuters also noticed the S&P 500 application software index was down 29% for the year, so Workday was underperforming even in a bad group. What broke at Workday was not one quarter. To frame the issue a bit further, it was the old investment case. The old case was simple. Workday was a premium enterprise application company with sticky demand, durable expansion, and enough embeddedness to grow steadily while the market paid up for quality. And to be fair, there is still real evidence behind that. In fiscal 2026, Workday did 9.5 billion in total revenue, 8.8 billion of subscription revenue, finished with 28.1 billion in total subscription backlog, 8.8 billion in 12-month backlog, 97% gross revenue retention, 2.9 billion in operating cash flow, and 2.7 billion in free cash flow. Non-GAAP operating margin reached 29.6 for the year. That is not a broken business. It is a large, profitable, still growing software company. But valuation is not just about what a business is. It is about what the market believed it would become. And that is where the trouble started. Workday guided fiscal 2027 subscription revenue to 9.925 billion to 9.950 billion, or roughly 12% to 13% growth. That is not disastrous, but it is still slower than the market wants from a company that still wants to be valued like a premium software name. On top of that, management said some large net new enterprise deals were taking longer to close, especially in federal, state, and local government, healthcare, and parts of the commercial market. That matters because slower deal conversion does not just hurt one quarter, it weakens confidence in future momentum. So the issue is not did Workday grow? It did. The issue is that Workday is now growing in a way that feels less special, while also asking investors to trust a major AI pivot. That is a much harder sell. So what's really happening at Workday is a collision of three things. First, the core application business is maturing. You can hear that in Workday's own language. In prepared remarks, Anil Busri said core enterprise apps in HR, finance, and student would continue to thrive. But in some areas like HR, the company already has high levels of market share, which means future growth is to come from selling more applications into the installed base. That is a very different story from wide open greenfield expansion. It means Workday is becoming more dependent on wallet share, cross-sell, and new product adoption rather than on raw category expansion. That is what mature software companies do. It is fine operationally, it is just not the kind of story that usually supports a rich multiple by itself. Second, Workday is trying to reinvent the growth story around AI, agents, and a new front end for work. This is where the market gets uneasy. In fiscal 26, Workday expanded its AI footprint through acquisitions including Flowise, Paradox, and Sana. The Sana deal was explicitly framed as turning Workday into the new front door for work, combining search, agents, learning, and enterprise data into a single experience. Workday said Sana had already served more than 1 million users across hundreds of enterprises before the acquisition. In its 10K, Workday also disclosed that it introduced Workday Sana as an AI experience layer for knowledge, agents, and automation across the Workday ecosystem and beyond. That sounds ambitious because it is ambitious. But ambition is exactly the problem. The bull case says Workday is taking a system of record business and layering an agentic interface on top of it before someone else does. The bear case says Workday is signaling that the old interface is no longer enough and now has to spend aggressively to defend its relevance. Both readings can be true at the same time, and the market usually hates that kind of ambiguity. Third, the company's capital allocation and operating moves tell you that management knows the ground is shifting. In February 2025, Workday disclosed a restructuring plan eliminating about 1,700 positions, or about 8.5% of its workforce, with estimated charges of 230 million to 270 million. The filing said that the purpose was to prioritize investments and maintain durable growth while continuing to hire in key strategic areas. By the end of fiscal 26, headcount had climbed back to 21,000, up 3% year over year, which tells you that this was not simple retrenchment, it was reallocation. Workday also spent 2.9 billion repurchasing shares in fiscal 2026. Ended the year with 5.4 billion in cash and marketable securities, and said fiscal year 27 margins would expand more slowly than previously communicated because of faster AI investment across product and go to market. That combination is revealing. Workday is not behaving like a company that thinks the next few years will look like the last few years. It is cutting, acquiring, reinvesting, changing pricing architecture around AI, and explicitly slowing margin expansion to fund the transition. That is not business as usual. That is a company mid pivot. The lazy take is that Workday just had a bad guy in a soft macro. That's incomplete. Yes, macro matters. If hiring slows, HR software gets less tailwind. If large enterprises delay decisions, enterprise application vendors feel it. Workday itself flagged lower large deal timing and said medium enterprise customers drove roughly 60% of its net new ACV in fiscal year 2026, which means the mix is already telling you where the easier growth is coming from right now. That's useful, but it's not the whole story. The other lazy take is that AI is about to wipe out Workday. That's also incomplete. Workday still has serious advantages. Growth retention at 97% is strong. Net expansion contributed roughly 60% of subscription revenue growth in both the quarter and full year. The company still serves mission-critical HR and finance workflows. In the 10K, Workday lists Oracle and SAP as primary competitors, but it also argues domain depth, compliance requirements, and global complexity create barriers for new entrants. That is real. You do not replicate payroll and finance systems because a chatbot demo looks slick on LinkedIn. So the real problem is more subtle. What broke was the market's confidence that Workday could move from great SaaS incumbent to AI era winner without a messy middle. And the messy middle is exactly where it is now. The company is still strong enough that the business looks fine on paper, but it is also uncertain enough that the stock no longer gets the benefit of the doubt. And that is a dangerous zone for premium software. Then there's the CEO change. In February 26, Workday announced Carl Eschenbach was stepping down and co-founder Neil Busri was returning as CEO. The company framed it as the right move for the rapidly evolving AI era. And the board called this a defining moment shaped by AI. Busri himself said AI is a bigger transformation than SaaS. That is a striking statement from the founder of one of the foundational SaaS companies. It also tells you the company does not view AI as a feature upgrade. It views it as a category reset. That can be bullish. Founder returns often are. But public markets rarely read these things with warmth and nuance. A founder return after weak guidance can also look like an implicit admission that the previous operating setup was not convincing enough for the next phase. It says, intentionally or not, that Workday wants founder-level narrative control while it tries to reposition itself. Again, that's not fail, but it is another reason the market stops seeing the story as clean. Now, the hardest part of Workday's story is that the company is trying to defend two claims at once. Claim one, our installed base, data, and workflows make us deeply defensible. Claim two, The future growth engine is agents, automation, and an AI centric front door for work. Both are plausible, but together they create tension. Because if Workday's moat is its deep system of record positioning, then the company should win by staying indispensable underneath the interface. If the growth story increasingly depends on being the new interface, then investors start wondering whether the original moat is less powerful than advertised, or whether the company is racing to own a layer it is not guaranteed to dominate. That is the strategic question behind the stock. Not is Workday good, not does Workday have AI, but what exactly is Workday in the next software stack? A system of record with AI on top, an agent platform anchored in HR and finance, a new enterprise work layer, or an incumbent trying to defend a mature core while building its next act under pressure. Until the market feels it has a clear answer, the multiple stays under pressure. So for investors, the lesson is that good fundamentals do not protect the stock when the narrative shifts from compounding to transition. Workday is still growing double digits. It's still throwing off cash. It still has retention and backlog. But because growth is slowing toward the low teens while investment intensity is rising, the market is treating it less like a premium grower and more like a company in strategic rehab. For operators, the lesson is even sharper. When your category matures, you cannot just add AI and expect the market to reward you for your effort. The AI strategy has to make the core business look stronger, not just more expensive. Workday itself warns it in its 10K that it may face customer resistance to new flex credits pricing for AI services, and that lower than expected AI adoption could hurt results. It also flags reputational, regulatory, and legal risks tied to generative and agentic AI, including compliance burdens from laws like the EU AI Act. That is not fear mongering. That is the company explicitly disclosing that this transition is operationally and commercially messy. So, what broke at Workday? Not the company, not the customer base, not the relevance of HR and finance software. What broke was the simplicity of the story. Workday used to be easy to own stock. Now it's debatable. And in public markets, the minute a premium name becomes a debate, the stock usually gets cheaper before it gets clear. Workday is still a real business with real strengths. The numbers prove that. Revenue is near 9.6 billion. Subscription backlog is over 28 billion. Gross retention is at 97%. Free cash flow is approaching 2.8 billion. That is not a falling apart company. But the market is no longer paying for what Workday was. It wants proof of what Workday becomes. And right now, that is the gap. The company is trying to move from mature SaaS leader to AI era platform. While growth slows, margins are being reinvested, leadership has changed, and the market has become much less patient. That's what broke. The old Preem story stopped being enough.